Okay, wanted to record, let's see here, one more problem doing chapter 7, just doing a little bit of the netting. All right, this one says, Tom and Amanda Jackson are married filing jointly. They have $200,000 of taxable income before considering the following events. All right, so I think on this one, I'm going to be able to just enter it straight kind of into my chart here. So, right, we know they have this much ordinary income already. On May 12th, 2019, they sold a painting, art, for $110,000. That was inherited from grandma on July 23rd, 2017. The fair market value on the date of grandma's death was $90,000, and grandma's adjusted basis in the painting was $25,000, right? So grandma paid $25,000 for it. It increased in value to $90,000. So we have to know, what is your basis in property that you inherit? All right, well, an inheritance, your basis is the fair market value on the date of death, right? Unless the estate elects to use a different date 6 months later, right? This problem, right, we can infer, right, we're going to use the fair market value on the date of death of $90,000. So let's see them right here. The painting, the basis would be $90,000. Amount realized was $110,000. Right, so the gain is going to be, right, the realized gain will be $20,000. All right, so that $20,000, right, it's from a sale of art, right? That's going to be in our collectibles category. That's going to be taxed up to 28%. Next, they applied a long-term capital loss carryover from 2018 of $10,000. Okay, long-term carryovers, right? They start, right, independent of what originally generated them. We get to start them in the highest long-term category. Right there. Right, if it was a short-term capital loss carryover, it would start in our short-term column. Okay, next, they recognized a $12,000 loss on November 1st of bonds they had acquired 10 years before. Right, so that's clearly long-term, more than a year. It's going to be a long-term capital loss, right? Bonds are just going to be in our 0, 15, or 20% category. They have a $4,000 gain on the sale of stock that they bought in February, sold in December. So that's a short-term capital gain. They recognized a $17,000 gain on the sale of rental property. Right, this problem, or at least the way I condensed it here, is a little vague, but we're supposed to assume this is real estate, rental property. Right, and this one is, well, is just going to tell us straight up, $8,000 of that gain is reportable as gain subject to the 25% maximum rate. Right, in other words, that's unrecaptured 1250 gain. That rental property had $8,000 of depreciation. So that $8,000 is going to go in our up to 25% category. The remaining $9,000, right, was the actual increase in the value of the property, and that, right, will just be treated, right? So this is 1231 asset, we're told, right? So it was a property used in their business for more than a year. So the amount, right, not due to depreciation, that gets to be treated as a long-term capital gain. Right, now be careful here because, right, this problem, we're mostly focused on the netting from chapter 7. So we're not doing the 1231 stuff. right? This says this is the only 1231 transaction. That's why I can put it straight here as a long-term capital gain. If there was other 1231 transactions, I would have to net them together, right, and do the look back before I could put it here. Right, but there's no other 1231s to net against in this problem, right? And because we don't have information, we're assuming there's no look back. They recognized a $12,000 loss on the sale of bonds, right? And these had been held for just less than a year. So that is a short-term capital loss. Put it here. A $7,000 gain on the sale of stock, right? And this was held for more than a year. That'll be a long-term capital gain. An $11,000 loss on the sale of stock. This was also long-term. All right. And we're told they also have they received qualified dividends in the amount of $500. I'm going to keep my qualified dividends over here. All right, so now that's all of our transactions. Now we can do our netting. All right, so first I just want to net each category. Right, so that capital loss carryover gets applied here first. It's going to reduce that 20,000 down to 10. Right, only one item here. I'll net these within the column. I think I should get negative 7,000. And this will come to negative 8,000 net loss. And I have my ordinary taxable income. All right, so now I've netted within each column. Now I want to start on the long-term side. Excuse me. I'm starting at the highest rate, and right now I'm looking for losses, right? This is a gain, I'm going to leave it. It's a gain, I'm going to leave it. Now this is a loss, right? It's a long-term loss. I have to apply it on the long-term side first, right? Starting at the highest rate. So I'm going to come over here, and I'm going to apply it against this. It's going to bring this down to 3,000. And now, right, I've used up that loss. I used it all here, so it's gone. Just bringing everything down to be extra clear. All right, so now I've used up all my long-term losses. Now I can move to the short-term category, and I have a loss here, right? Let's say, all right, I didn't have any of this stuff. All right, just for educational purposes here, this is outside of the problem. What if I only had a short-term capital loss and ordinary income? I would be able to use 3,000 here. I would bring my ordinary income down to 197,000, and I would have $5,000 left, right? Because the most I can use to offset ordinary is 3 in a year. That extra 5,000 would be a carry forward, right? That would start the next year, 2020 in this case. It would start it as a short-term capital loss, as if they had that loss that year, right? I would start it at the top of this column, right? Just to review what we do if we ended up with a net short-term loss. Let's go here. All right. And back to where we were. But right before I can take any short-term loss to offset ordinary income, I have to use it over against the long-term gains if I have any, and I do here. So first, right, I'm going to go over, I'm going to start at the highest. So I can use 3,000 of it here, and there's another 5,000 left that can go here, right? So now this is down to 0, right? I've used it all up against my gains over here. And I eliminated that collectibles gain from the painting, and I'm left with 3,000 of my unrecaptured 1250 gain. This was already 0, and I didn't get to reduce my ordinary income. And I still have my dividend over here. A dividend is not part of the netting process of your gains and losses. Okay, so now I can calculate the tax liability, right? Their taxable income is going to be $203,500. To calculate the tax liability, right, I've got my, where are they? Right, so I use the rate schedule here, right? Starting with their ordinary income of $200,000, they're married filing jointly. I can see they'll be starting right here in the 24% bracket. So I just use the formula, right? So I copied this formula here over here, right? Right. So, right, I just did right, an Excel formula here, right? Basically, I'm taking their tax ordinary income minus the bottom of the bracket times 24% plus the number the IRS calculated for me. Their ordinary tax liability is going to be $36,349. Next, I want to go to any of these, right, 28% or 25% gains. I know it's confusing to call them 28% and 25%, even though they don't always get taxed at that rate. And I guess that's what I like about it. It's confusing. Just kidding. I don't like it. It's kind of just what people do. Okay. So this three, I would do this collectibles gain first if I had it. All right. I want to look at these brackets, right? But I don't. So now I have this 3,000 unrecaptured 1250 gain. All right. So if I look here, I want to see, right? So I'm up to, right, 200,000 of income that I've taxed at the ordinary rates. And I can see, right, this 3,000 will fit in the 24% bracket. Since that is less than the 25% max, I can use that. Right? What they're doing with these is they're saying, we don't want to give you the total preferential rate that other capital gains get, right? But we still want to give you a break, right? But we're not going to punish you and make you be taxed more than ordinary income on it. So if your ordinary income is less than these maxes, you can do that, right? So here it fits still in my bracket. Make that bigger. Why not go bigger? Go bigger, go huge. Okay. It easily fits here. So, right, let's see. I'm going to delete this from the painting. So on my unrecaptured 1250, right, that's going to be that $3,000 gain, and I'm going to tax it at the 24% rate, right, since the ordinary rate is lower than 25%. Right. If I would have ended up with a collectibles gain, right, it would have been the same thing, right, because this is lower than 28, I would tax it at 24%. So now I just have, right, I don't have any other gains. I've done my ordinary income. I have this qualified dividend. So I want to look at the brackets for long-term capital gains and qualified dividends. And now this is a little confusing, but where I'm in married filing jointly, 0, 15, or 20. Where I start is all the income that has been taxed at ordinary rates. So in this problem, it's the 200 plus the 3,000. So 203,000, right? That's easily within the 15% range. Right, so for my qualified dividend, it's going to be taxed at 15%. So my tax on that is going to be the dividend times 15%, $75. All right, so their total tax liability is going to be the ordinary tax liability, the unrecaptured 1250, which was also taxed at ordinary rates, and my dividend, right, should give me a total tax liability. Okay, so, right, that's the problem. One other thing we can note, right, so if you, all right, I know a lot of you, all right, put some good time into the Ron and Ann problem in chapter 7, which was similar to this, but the tax calculation part is harder. All right, so the solution to that one, right, the solutions for chapter 7 and chapter 11 should be on Blackboard right now. Let me know if they're not. All right, if you can understand that problem, all right, you're in good shape too. All right, so because the other thing that could happen, right, so if we're close to the borders here between 0 and 15 or 15 and 20, part of my gain could be taxed at one and part of the other. And so where I start once again, right, so what could be different here, for example, my 1250 gain was taxed at the ordinary rates. So I count it when I'm figuring out where I start. But if it got taxed at the maximum rate, 25%, or if it was one of these that got taxed at 28%, since it didn't get taxed at ordinary rates, I don't have to count it to know where I start here. Right, so if my ordinary income, right, let's say was, for this married couple, if the ordinary income had been 350,000, then any gains here would get taxed, right? Since I'm already in the 32% bracket and it's higher, these gains would be taxed at 25%, or any of these would be taxed at 28% right now, because those are lower than the ordinary rate. And then, and if gains here hadn't been taxed at ordinary and my taxable income was, my ordinary income was 350, right? I would just start at 350 here, and I would still be in the 15% range. All right, hopefully that helped clarify and didn't confuse you more. All right, definitely let me know if you have questions, and I will try. I've been having some issues with my internet, but I will try to schedule a Zoom meeting or two before finals for people that would be helpful to.